Thank you for everyone who has chosen to join us today. Excited to get into finances and taxes with you. So let me get started. If I know how to share a screen, I'm sure that I do. All right. So today we're going to be talking about tax tips. That is going to start from a baseline of accounting and really jump into all of the other questions that I know have come up around S-Corps and deductible expenses and all of those things. And if you've been with us before or listened before, some of this will be a refresher, but I also wanted to use this time as a level up to say, here is the best baseline, and then here's some additional information that might be helpful to you. About me, I do run a boutique CPA firm called Little Fish Accounting. We work with small business owners across the country. One thing I like to say here is I am an accountant, but not your accountant. So all of this information will be general in nature. It will absolutely be helpful, but may not speak to your specific situation. So make sure you talk to your accountant after this if you've got any really laser focused things that are happening with you, but I will answer as much as I can as part of this presentation. Now, before we get to taxes, the first thing that we need to do is know our numbers. And the reason that I bring that up first is because knowing your numbers, understanding what you're making and what you're spending is really the first step towards your tax return. Think about your tax return as settling up later on. We'll talk about all of the steps related to that, but that's the end of the story. You really need to be understanding your numbers throughout the year because that's when all of your decisions are being made. It also helps to diminish the fear. There's a lot of feelings around finances. You may not always know what's going in and what's going out. And so you end up relying on other people to give you information on what your business is doing. So when you're tracking everything that comes in and out, you're better equipped to make strategic decisions. So a lot of people are wondering, like, when can I hire help? When should I hire an accountant or a lawyer? Do I have enough money to do these things? And that starts from a place of I'm tracking everything that goes in and out of the business. So I know how much already is allocated to like run my business. And for purposes of this webinar, you are a business, right? So even if it's just you and you're paying some contractors or you're not paying anybody but yourself, you are the business. And so we want to treat it as such, right? We have income coming in and expenses that are related to that. And we'll get into details of that, but you want to start thinking in that way because it really incorporates all of the stuff we're going to talk about in terms of bookkeeping and taxes. Now, speaking of bookkeeping, I figured that this was a good time to talk about cash versus accrual. So for those of you who don't know, cash and accrual are two accounting methods on which you can look at your financials. And your financials, that can be your profit and loss, it can be your balance sheet, it can be both. But cash means that you are recording revenue when you receive it and recording expenses when you pay them. So this means that nothing hits the books until cash exchanges hands, meaning that if you send an invoice out, you don't even count it as revenue until somebody pays it. And if somebody sends you a bill, you don't count it as an expense until you spend the money on it. The opposite or kind of opposite side of that is accrual. Accrual means that you earn income. So you mark it as income when you send the invoice or when you earn it, and you mark it as an expense when it's billed. So when you receive the bill, regardless of when you pay it, it is marked as an expense. This is going to come up later. I know there were some questions about like bad debt expense or write-offs. Some of that is dependent on how you record your income and expenses. Now, the easiest way to record is cash because it's like your checking account. When money comes in, I'm going to call it income. When money goes out, I'm going to call it expenses. The thing that accountants, don't like about cash is that it's not timed the same way. So let's say that you send an invoice this year, but they don't pay you until next year. If you're on a cash basis, it doesn't count until income until next year, but you probably want to see that it's counted alongside when you actually did the work. So if you did the gig in November, that's when the work was done. That's when we want the money to align with it. And that's when accrual comes in place, right? Because you're going to go do the show and then you're going to invoice in that same period. Now those match. If you're on cash, you might invoice in the same period, but it doesn't count until you actually receive the money for it. So I'll answer any questions on that, but it comes up a lot in trying to know the difference between the two. A lot of accounting systems will automatically put you on cash basis because, again, it's the easiest one. But cash basis is not going to have any outstanding invoices or bills because, remember, it doesn't care unless cash exchanges hands. Now, the first thing that I tell everyone, no matter what you are doing, no matter how long you've been in business, the most important thing that you can do with your finances is to track everything. Track everything that comes in and out of your account, out of your business account. We'll talk about that. But track everything that comes in and out because that's what tells you how your business is doing. It tells you what you're spending money on. It tells you what you're making money from. All of this is because you're seeing all the transactions as they process through your account and you're categorizing them accordingly. Now, you want to retain your receipts. Now, I tell everyone I'm not going to look at a shoebox full of receipts, but it's important that you hold on to them in case of an audit down the line. And there's a bunch of digital tools to be able to do that. But the easiest way is just to take a picture and save it to the document storage platform of your choice. That way, you've always got a copy of it, and you want to save it generally in one of two ways. Either you want to make folders by month. So you'll say, this is all of my receipts for January. These are all of my receipts for February, and so on, or by type. These are all of my professional services receipts. These are all of my lawyer receipts. These are all of my meal receipts. You really just want to make it so that if you ever had to go back and pull them, it's relatively easy for you to figure out where they are. Next, don't rely on bank statements. You're really going to want to use some kind of accounting system. And the reason is because your bank statements don't put it into categories for you. So it will tell you you had $100 at the beginning of the month and now you have $43, but it won't tell you what you spent it on. So a lot of times when I hear people say, I don't know where my money went or I don't know how I spent that much, it's usually because they're looking at their bank statements and just seeing how much money is left in the bank and not where it was spent throughout the period. So instead, 3, you want to switch to cloud accounting. I recommend QuickBooks. All of our clients are on it, mostly because they've been in the game for a long time and they have different options for you. But honestly, use the one that you are actually going to go in and use. And your cloud accounting system is going to make life easier for you because it connects to your account. So you have this separate account that has everything going in and out of it. It connects to that account, and then you can categorize from there. This means you don't have to remember, oh, well, when I went on this trip last week, how much did I spend? It's always going to pull out of that account. And the bonus is that it creates financial statements from what you did in order for you to be able to see a very clear P&L. This is what we made and this is what we spent. So keep this in mind, track everything that's coming in and out, because again, this is going to be the baseline for everything that you end up doing in preparing for taxes. Now, I said to have a business account. It's so important that you keep your personal and your business expenses separate. The first thing is that legally it can help protect you. A lot of times we want to have a very clear line of demarcation between what we did personally and what we did for business. And part of that is because if anybody ever came after you, sued you, or had a lawsuit against you, we want to be able to say that they can only go after the business assets and not your personal. The other reason is that it just makes your accounting easier. If it's connected to a business bank account, we know that you don't have to go through and say, ignore my rent, ignore this dog food, only pay attention to these expenses. You also don't want to run afoul of the IRS. If they start looking and there's too much commingling, they can say, hey, we don't know the difference. And so just don't allow deductions for any of this. So keep that in mind. You always want to have a separate account. Now, when you first start, if you don't have a business name or an EIN yet, just create a separate account. That's your first step, is to make sure it's operating separately from what's in your personal account. But an EIN is free. And so you can be a sole proprietor, go to the IRS, get your free identification number. And that, in addition to setting up with your state, will generally allow you to be able to open a business account and or credit card so that you can use all of the money accordingly from the right account. A note about Cash App and Venmo, to the extent you can, don't use them. They're difficult to track, and the IRS is putting in rules anyway to have you report on that income. It really just makes it easier if you can have everything come directly into and out of your business account. Now, let's talk about business entity types. Now, the most straightforward and the one you don't have to do anything for generally is a sole proprietorship. You start selling something out of the trunk of your car, you're a sole proprietor. There isn't any paperwork needed. You are automatically a person who is getting self-employment income by doing something, selling something, right? The next kind of level up is your LLC. And the LLC gets articles of organization that you're getting from your state department. And the LLC is a legal liability or a limited liability company. It is a legal thing more than an accounting thing. And what I mean by that is that when we talk about taxes, an LLC is considered a disregarded entity. And what that means is that there is no difference from a sole proprietor and a one-person LLC in terms of the way that it's taxed. An LLC is really another level of protection between your assets and the business assets so that you don't have anything so that you don't have anything overlapping. And the reason that I bring this up too is because I'm on the internet with y'all and I see people giving you all kinds of advice of all the things that you can do with an LLC. There isn't anything tax-wise that you can do with an LLC that you couldn't do with another type of business entity. We'll go into specifically the difference between LLCs and S-Corps on the next slide. But what I want to say here about a partnership is that if you don't do anything, a partnership is a sole proprietorship with more than one person. So if you don't register anywhere or do anything differently, if two people start a business, it is pretty much automatically going to be considered a partnership. An S-Corp is not a business entity type per se. It is an election. So what you're saying is I am already an LLC and I would like to elect to be taxed as an S-Corp. And we'll talk about what that means in a second. A corporation won't apply to most of us, but it is the most disconnected from you as a person. So whereas these others are passed through, the income ultimately ends up on your personal return. A corporation has its own return. It lives as a completely separate entity from its owner or owners. It has its own tax rates, its own tax burdens. All of those things are completely separate. So when you say that you are incorporating, that generally means that you're going to have a corporation, which doesn't apply for most of us. Now, let's talk about S-Corps. So again, it's not a business entity type. It's a tax savings election. It is saying, I am an LLC. I have already set all of that stuff up. And now IRS, I would like to be treated as an S-Corp. Now, all states don't do this the same. It would be nice if they did, but you will find in this presentation that states are not consistent in the ways that they treat things. So some states treat your S-Corp like the IRS does, which is to say that it's a pass-through. So if you're a single member LLC, every time you get paid, that is essentially considered income to you. And all of your profit is taxed at with self-employment income. So the IRS says, if you made $100,000 in profit, I don't care if you gave it to yourself or you left it in the bank, all of that is considered yours and we're going to tax you accordingly. An S-Corp says, actually, I earned a wage from having an S-Corp. I got paid on payroll. I got a W-2 at the end of the year, and I already paid payroll taxes on that. And so the profit that is remaining in the business is actually going to be taxed at just with withholding. So it's not going to have the Medicare and Social Security that gets assigned when you have wages. Why is this important? Well, one, that's where the tax savings comes in. So think about if you made $100,000 on as an LLC, and we're going to call this profit, the IRS is like, cool, that whole $100,000 is taxed with withholding. So that's income tax and self-employment tax, which is Medicare and Social Security. If you're an S-Corp, that $100,000 is only taxed with withholding. It doesn't have that Medicare and Social Security. So you save a significant amount of taxes that don't get applied there. One of the rules Hold on one second as my dog snores. He does not care that I'm doing this. That's fine. So one of the requirements as an S corp is that you pay yourself a reasonable salary, and we'll go through this on another slide or the next slide about paying yourself. But that's something to keep in mind. You can't just take money out just whenever you want to and not have any tax consequence. There's an expectation that you are working for the S corp, and as a result, you are paying yourself a wage for doing so. So hopefully that gives you a sense. But when we're looking at the difference, a single member LLC is taxed as a sole proprietor. A multiple member LLC is taxed as a partnership. So what that means is that all of that income is going to end up on your individual tax return and have self-employment taxes applied. When you have an S corp, one of the things that you need to build in is that that is going to have its own return. Now, it's an informational return. It tells the IRS, hey, this money is going to be taxed on Jane Doe's individual return, but it does affect, like we talked about, what taxes are ultimately applied. And I'll answer any questions about that after we go over paying yourself. So, paying yourself is different than transferring yourself money. So if you're an LLC or a sole proprietor, because remember, an LLC is a disregarded entity, the IRS does not care about it. You don't actually pay yourself a salary, and the money that you give yourself is not an expense. So I always use $100,000 because it's very easy math wise. But if the business makes $100,000 and you transfer yourself 50,000 to like just pay for your life throughout the year, as a sole proprietor or LLC, you are not going to get any credit for that. The IRS is like, I don't care how much you transfer to yourself, you are going to end up paying taxes on that $100,000 the same way. You take them as owner's draws. There's no tax impact, no benefit. It's not an expense. It is just something that happened, kind of transferring between two bank accounts. When you're an S corp, remember, you're required to pay yourself a reasonable salary, and that's an expense because you're an employee like anybody else that would be earning wages in the business. And what that means is that you're paid through a payroll system. Payroll taxes are withheld throughout the year, just like any other employee. And at the end of the year, you're going to get a W-2. Now, that looks different. So if you're an LLC or a sole proprietor and you pay yourself, it's not really paying yourself, it's just transferring money. If you're an S corp and you pay yourself, you should be on payroll. And there are plenty of systems that will do this for you. ADP is one, Gusto is one, multiple platforms that will allow you to pay yourself and pay payroll taxes on your behalf so that you don't have to worry about doing that yourself. Now, before I get into annual taxes, what questions have come up so far? All right, I'm gonna try to answer some that are in Q&A. If you are asking the chat, make sure that you put them in Q&A so that they don't get drowned out. Opinions on keeping all receipts. So the rule for the IRS is generally like $25 or above. Here's what I'll say about receipts. How hard is it for you to capture it? So just because you don't have a receipt doesn't mean that you can't deduct it. But if you can just take a picture of it and save it, it will work to your benefit to stand up not just for that expense, but potentially for other expenses. So for example, let's say that you never saved a meals receipt because it was always low. It may be hard for you to prove later on that this $1,500 that you spend in meals is actually real, right? You don't have any proof that you did it. But again, on the flip side of that, if you're missing a $25 receipt, it is unlikely that they're going to say, well, no, you can't take this. Remember too that receipts are for the IRS if they come back and ask for them. So generally your tax preparer doesn't really need them. They are mostly to serve as support documentation so that if the IRS requested it, they could see that you have proof that you incurred that expense. In terms of using Venmo or Cash App, so one, Venmo and Cash App, along with PayPal, all of them are getting rules with the IRS where if you get more than $600 in money from there, you are going to have to get a 1099 for it. The other thing that I don't like about Venmo and Cash App is that usually it is difficult to see that really clearly on your accounting system. You can use whichever one you want and makes sense for you. I don't like it, one, because if you don't have the business Venmo or Cash App, you're actually against their terms of service because they want to charge you a fee for every time you pay somebody. That's part of the transactions of doing business, but also because it doesn't feel like a very good way to track expenses directly from your bank account in a way that you could if you were using something like a PayPal or a Zelle or a Stripe. Oh, good question on the level of income to form an S-Corp. Usually I say that an S-Corp should even be considered after you're making $50,000 to $75,000 in profit. Because remember, you're going to have to pay for a payroll system. You're going to incur payroll taxes. You're going to have an extra tax return that you need to file. And you're going to need to be able to make sure that you're tracking what you need to throughout the year. With all of the governmental burdens that come with having an S-Corp versus just having an LLC. So if you're making at least $50,000 in profit, you should at least start asking your accountant about it. It doesn't mean that you should. Some states have additional ramifications like New York and California that may make it so expensive that it's not worth it, but that can at least start it for you. If you are adding a partner to your LLC, that's a legal question more than an accounting question. I'll say that the most important part is to have a partnership agreement that lays out exactly what everybody's responsible for, but also what is going to be taken from a profit and loss perspective. So how much are you all going to be claiming? How much is going to be attributed to you on the tax return? That information all needs to be in the agreement. And I will answer two more questions. Can you change your LLC to an S-Corp in California? Yes, you'll just need to file with California. They have specific rules on what you need to set up in order to be treated as an S-Corp there. And can you reconfigure an LLC after creating? I don't know what that question means. So if you'll give me some more context on that, I can come back and answer it later. All right. Let's get back into taxes. All right, so there are a couple of different types of taxes, some of which I've already covered. So the first one is withholding tax. That's income tax. That is the tax that you pay for the privilege of doing business. Then you have self-employment tax. Remember, that is Medicare and Social Security. When you work for somebody, you pay the employee share of Medicare and Social Security, and your employer pays their share of Medicare and Social Security. Self-employment tax is both sides, because when you work for yourself, you're the employer and the employee. So the employer-employee side of Medicare and Social Security is what comes together to be your self-employment tax. Sales tax is generally taxed on products, not services. And the thing you need to know about sales tax is that it should be a pass-through. So you are just a holding place for sales tax. You collect it from people who buy from you, your customers, and then you remit it to the state. So if you sell something that costs $100 and then you charge $10 in sales tax, you're just holding on to it until the end of the month or the quarter when the state says that you have to report it. It's not income or an expense because remember, it's just going through you. And then franchise tax is a weird one. Generally, franchise tax is a fee. So what you'll see is when you file your state tax return, franchise tax is sometimes based off of the income that you made. So usually it's state related and says, hey, of the income that you made, it's kind of your income tax for the state for your business. 8% is being applied. Sometimes it's a fee and they'll say, okay, it's $300 for a franchise tax. That's not really a tax because it's not based on income, but just so if you see that come through, usually that's due on an annual basis at the top of the year, or it's due when you file your tax return. So just look at your state to see which one is applicable to you. Now let's talk about how taxes work. I always go over this slide because I just really think that it's important to walk through what your tax return is trying to tell you in a way that I don't think is always explained. So the IRS in most states are pay as you go. This means that they want their money throughout the year. They do not want to have to wait until you file your tax return. And so what happens is you earn income throughout the year, either as a W-2 employee where you get paid and your employer is sending off your payroll taxes on your behalf to the IRS in the state, or you're a 1099 or freelancer or self-employed individual who is making money throughout, and then you should be making quarterly payments. Now, quarterly payments do a couple of things. One, they avoid penalties and interest that will occur at the end of the year if you don't. Again, the IRS doesn't want to have to wait until you file your return. So if you made all your money last year and you don't pay them until this April, they'll charge you penalties and interest for all of the quarterly payments that you should have made last year on the money that you were making. Now, remember that all tax payments throughout the year are estimates. You are doing the best you can to say prepay your taxes in advance. So throughout the year, those payroll taxes that they're taking or those quarterly estimates that you're paying, they are all estimates. They are trying to say, this is what I think I'm going to owe you at the end of the year. At the end of the year, your tax return is kind of settling up. So you've got final documentation that says, hey, this is how much I ended up making in income, in 1099s, in unemployment. This is how much I actually brought in. Here are all of the deductions that I had or expenses, any tax credits that are applied. And at the end of that, the IRS says, cool, and the state says, cool, this is how much you owe us in taxes. Say it's $10,000. Or this is how much you should have paid in taxes. The next line says, well, I already gave you some of that. I paid estimated taxes, or y'all took this out of my check throughout the year. And so if you overpaid, if in this example you gave $12,000 throughout the year, you'd be due a refund. If you underpaid, say you paid $8,000 in the year, you'd have to pay the difference. So this is why I say that everything that you're doing throughout the year is really preparing you for tax season. Because by the time we get to the tax return, it kind of is what it is based on what you did last year. Whereas if you're doing it throughout the year, if you're making your estimates, if you're keeping up with your numbers so that you know exactly what is coming, even if you can't pay it right then, you're less surprised when it comes to tax season, but you're also not trying to make changes after the calendar year ends, which is generally too late. Now let's talk about deductions. There are standard deductions and there are itemized deductions. So for now, we're going to shift our brains to the personal side of your tax return. The standard deduction is something that is automatically given to you by the IRS. And the IRS basically says, if you don't have any other deductions, if you're a single person, I'm going to give you about $12,000. If you're married filing jointly, I'm going to give you about $24,000. And if you're head of household, I'm going to give you about $18,000. This is a reduction in taxable income, not a taxes reduction. Ugh. Okay, so what does that mean? It means that if you made, my favorite, $100,000, they're going to tax you on $88,000 if you're single, because they're going to say 12,000 of this, we just going to call that an L, and we're not going to tax you on that amount. If you're married filing jointly, again, $100,000, they're going to say, it's fine. We're only going to tax you on $76,000 of this. And so this is something that is automatically applied for everyone. You have a choice between the standard deduction and the itemized deduction, and you're just going to pick the one that's bigger. So if you don't have any itemized deductions, standard deduction is automatically going to be applied, and you'll be able to take advantage of that. Itemized deductions include things like medical expenses, which have to exceed a certain threshold, state and local taxes, which includes real estate taxes that you pay for your house, mortgage interest, and charitable deductions. You're going to add all of those up for yourself, and you're going to pick the bigger of the two. So if you're single, you're going to add all of those up. If your itemized deductions are more than $12,000, you're going to take itemized. If they're less than $12,000, you're going to take the standard deduction because you want to get the bigger one. Remember that this is reducing your taxable income. So you want to take the number as big as is legally allowed for you to, because then it means that you're paying taxes on less income. Now, remember that we talked about partnerships and S-Corps. Neither of these is taxed at the federal level. What does that mean? It means that for both partnerships and S-Corps, you file what is essentially an informational return. it says, hey, the business made this much money, but we are not going to pay you any taxes because Keila, the business owner, is going to pay taxes on this amount when it comes to her individual return. So what you'll do when you're making these estimated payments is you're actually making them under your social, because that's where the taxes are going to end up. Let me explain. So partnerships and S-Corps have their own tax returns. You're going to put all of your business income and expenses and all of the things that come out, and you come to the profit amount. That profit amount is then going to be kind of sent to a K-1 document, and each partner or shareholder in the company is going to get a K-1 for their respective part of that profit. That K-1 you're going to carry to your individual return and say, hey, I need to add this income to my tax return in order to be taxed on it. So even though it is its own tax return, it doesn't pay any taxes to the IRS. Those taxes are actually going to come through you. And if there's any questions on that, I will definitely try to answer them. But the most important thing to know is that when you file your partnership return or when you file your S-Corp return, there's not going to be any tax due at the federal level. States vary. Some of them treat it the same way, where it's a pass-through and you're going to get taxed on your personal. Some of them treat it like a corporation, and they're like, we're not even going to wait for you to get it to your personal. We want our money now. But just so you have a sense of like, this other return is going to be filed, but just because no tax payment is coming out over there doesn't mean you don't owe any taxes. The amount that you owe is going to be dependent on your tax situation, on your personal taxes, and everything that comes along with that. All right, before I go to deductible expenses, I will stop and try to answer some of the questions that have come through the Q&A. Let's see. I answer these. Setting up an LLC, that is going to be a legal thing that you do through your state. You can do it through some third-party softwares, but generally I say that you want to go to your Secretary of State, and there are always instructions that will walk you through how you register for an LLC in the state and what you'll be responsible for. Can you pay yourself retroactively with a lump sum in time for taxes and elect to be treated as an S-Corp? That's a good question, because I did not talk about the deadlines. So an S-Corp election should be made by the third month after your business is created, or the third month after the end of your year. So usually it's going to be March 15th. You can ask for a late election later in the year, but essentially you would have already needed to be treating yourself as such and have a reason for why you didn't do it earlier in the year. You can pay yourself retroactively, but remember that it's a salary. And so you need to pay payroll taxes on that amount. You need to file those payroll taxes with the IRS and the state before the deadlines so that you don't get any penalties. So an example is, generally those reports were due yesterday. So if you elect to be treated as an S-Corp retroactively on the 30th of this month, like for some reason you have gone in and been like, oh, I should have been that last year, and you run payroll, you are now late for all the payroll taxes that should have gone to the IRS and state by the end of year deadline. So just keep that in mind, that you'll still have other items that come up alongside that. Let's see. If you're a single member S-Corp on payroll, do you still have to pay estimated taxes? Yes, because remember that your estimated taxes are on the profit from the S-Corp. So when you're paying payroll taxes, that's just on the wages that you're earning. But the remaining profit that's in the business, you wouldn't have paid any quarterly taxes on. So remember that your payroll taxes is just on your paycheck. Your estimated taxes are going to be on the profit that's left over after you take out all the expenses, including paying for yourself. I'm a tour manager. Should I set up an S-Corp or LLC? I'm currently W-2 through the band that I work for. So that's really going to depend on you. And we'll talk about employees versus contractors, but most of that is going to be dependent on how much control they have over your work and whether you're allowed to be a W-2. You being a W-2 for them isn't really related to whether your business, if you're a contractor with them. So hopefully that makes sense. You could be an LLC and be W-2'd with them. You could elect to be treated as an S-Corp, be an employee of your S-Corp, and also be an employee of them. They don't have to talk to each other that way. All right, difference between a Schedule C and a Schedule E. So a Schedule C is what you're going to report on if you're an LLC or a sole proprietor. Actually, the Schedule C is one of the easiest reports for you to look at because it is literally revenue minus expenses and what your profit is. It should look a lot like your P&L. Your Schedule E is where the information from your K-1 documents comes. So we talked about if you're a partnership or you're an S-Corp and you have that K-1, that remaining profit that's being assigned to you for your tax return is actually going to live on a Schedule E. It doesn't have all those details though, because all of that was on your business return. So think about your Schedule C as kind of the business return or business page for your income and expenses if you're a sole proprietor or a one-person LLC, and your Schedule E is just the summary. It is just saying, hey, based on that K-1, here's the number that ends up living here. If you have an LLC, yes, please set up a separate bank account. This is going to be super important with, again, making sure you're making the distinction between what was business related and what is personal. And your LLC may even require it because it's trying to say, if I am saying that this business is legally separate from you, it should have all of its own stuff, including its bank account. You can tie your business card to your PayPal, Venmo accounts for merch sales. All of that seems fine because it's income and it's going to be reflected as it comes through. It will just be coming through your business card or your bank account. All right. And then a LLC sole proprietor is not the same as an S Corp. So we'll just real fast, sole proprietor, you don't have to do anything. You just start selling stuff. You're a sole proprietor. Congratulations, business owner. LLC, you go through paperwork with the state to say, hey, I want to set up to say that this business is legally separate from me. And I'm going to do the things that I need to make sure that it's kept separate. A S-Corp is a tax election. You are still an LLC. You have just asked the IRS to tax you as an S-Corp. So remember, it's not a business entity type, it's a tax election. In terms of when run the Keeper app. Oh, you can use that to do bookkeeping. I always recommend that you use an accounting system, a true accounting system that shows income and expenses, because if not, it can be really difficult for you to be able to see exactly how these things were categorized. But if you have a methodology, any software that will do that, use it because it makes your life easier when it comes to tax time too. Let's see. Can a business credit card statement serve as proof of expense when no? You have to have receipts or some kind of proof of what you paid for. And the reason is because when you think about it, your bank statement or your credit card may say the company that you paid, but it doesn't say whether it was deductible. And so, for example, let's say you went to Target, right? And you bought a desk. Your credit card receipt is going to say that you went to Target, but you don't have a receipt to say what you spent on so that you can prove to the IRS that this was a deductible expense. So no, you can't use it generally in a review or audit. It's always safer to just have the receipt. All right, let's go over deductible expenses. All right, so there's two rules for deductible expenses. Generally, you want to make sure that they are ordinary and necessary. Ordinary means that they are typical for the business, they are common for you. Your peers are going to be incurring the same types of things. Deductible. Necessary means that it's helpful to do the business. This means that it doesn't have to be my business could not run without this. An example that I always give is that we have a podcast. It's called Build to Enough. Rebranded from Fish Food, where we give bite-sized accounting advice. And for that, I had to buy a mic. That mic is not necessary for me to do accounting work, but it is necessary for that arm of our business. And so that is going to be considered ordinary and necessary, and I was able to deduct it on my taxes. Now, once you know that, you can go through some of these not in the boxes because the green boxes mean that there is something special about them. So, again, remember that you can look at the Schedule C. It is going to give you at least an overview of general categories that things should live in. But remember that the IRS is not checking you for categories. So they are not looking to say, oh, your website should have been in office supplies instead of advertising. My goal and my advice is that you're just consistent about how you do it. And so you want to make sure, okay, I have gone through and every time I code the website, I always code it as advertising, or I always code it as office supplies. Advertising is money that you spend to put the word out about your business into the world. So this can be anything from social media ads to actual flyers to business cards. Training and professional development, that can be coaching, training, lessons that you're taking, webinars that you attend if you have to pay for them. Insurance, although self-employed people generally are able to take advantage of a health insurance deduction, the insurance that I'm mentioning here is business insurance. So any liability insurance that you pay for your business, that is going to be a deduction. Travel, this includes lodging, transportation, meals, all of the things that you got to pay for because you went on travel, those are going to be deductible. Equipment and supplies is self-explanatory. And then legal and professional fees. This includes paying your tax preparer, paying your lawyer, paying for a graphic designer or somebody else that is helping you to bring your business together by doing something that they're an expert in. A couple of not exceptions, but special rules, setup costs. So remember that if you are just starting the business or you are just starting to employ yourself, setup costs are going to be deductible based on when you incur them. So as soon as the business is, or as soon as you've started performing the work, you want to make sure that you start taking advantage of those setup costs. Let's say that you had to pay for your LLC and you had to pay for some reports and you had to pay for somebody to look into things for you before you actually went on the road or before you actually put yourself forward as being self-employed, you'd still be able to deduct those throughout the year because it's what you incurred in that year. Meals are generally going to be 50% deductible. And remember that you can't be eating by yourself unless you're on travel. So if you're on travel, you can deduct the meal because you had to eat while you were out of town. But if you are local to your home, you can only deduct if it's business related. So this means that you're talking to a member of your group. This means that you are meeting with your manager or pitching for a venue that you want to be able to perform at. All of those are going to be meals that you can deduct. Home office, because the IRS likes rules of two, your home office must be regularly and exclusively used. This regularly means that this is where you generally perform the work. More often than not, this is where you're doing it. And exclusively means you don't use it for anything else. So if you practice at your dining room table, it may be regularly used, but you also eat at that table, so it's not exclusive. If you live in what I call a high rent district, all of these major cities across the country that are just the rent is too high, know that it doesn't have to be a separate room. It can just be kind of a cutout. And what that means is I have seen people use closets. I have seen people use corners of rooms. As long as that space is regularly and exclusively used, you can take the square footage of that area, divide it amongst the square footage of your entire house or apartment, and then you're going to be able to use that percentage to allocate across other expenses like your rent, your utilities, all the things that like go on to the home office, but also make the rest of your house run. Finally, mileage. If you are driving your car, you're going to want to track your mileage for business trips. So generally there are apps. Mile IQ is one that you can put on. It'll track every single trip that you take and you kind of swipe one way if it's business, swipe the other way if it's personal. And you want to keep that because you can take mileage based on the standard rate just on business miles. So they update the rate every year. It's over 50 cents. But if you just track your business miles, you can usually use that as a deduction. Before I move on, I also just want to talk about contractor versus employees. And No, normally, whether somebody is considered a contractor or an employee is based on a level of control. So, if I tell you when to come to work, how to do your work, how often you should be doing it, what systems you should be using, all of that stuff, if I run where you go and how you do it, you are usually an employee. A contractor generally has more flexibility, meaning that I say that I need a thing to be done. I need this performance done. You take care of all of the rest of that and expenses related to it. I just need a deliverable from you. The main difference is going to be the forms and the payroll tax responsibilities. So there's no payroll taxes for contractors. You just get paid or pay contractors their fee. They worry about their own taxes when they get home. A contractor gets a 1099 every year. These are due at the end of January. So what you're going to want to do is collect a W-9 from anyone that you paid more than $600 throughout the year. My cheat code is that when you hire a contractor, get their W-9 then, so you don't have to chase them down for it later. And then there's free services, not free, low cost services online that will allow you to file a 1099. One is track1099.com, and that'll allow you to put all of the information in from the W-9, enter how much you paid the person for the year, and then be able to send out their 1099 so that you're not doing it by hand. A W-2 is generally going to come from a payroll company. So again, all year long, they're getting paid. Payroll taxes are being withheld. Those reports are being filed by the payroll company. And at the end of the year, that payroll company will send out W-2s. All right, we're getting close to the end, so I want to go in and answer some more questions. Give me 1 second. Because of course I have all of the windows open. All right, let's go to Q&A. Okay, if we do personal activities on tour, does that negate the whole tour as far as deductions go? Actually, this is a good question just about like expenses in general. Remember that you don't have to do it 100%, but the main purpose of what you're doing has to be tour related. So if you are going on a trip and it is for the tour and you stay an extra couple of days because it's a cool city and you want to hang out there, you can deduct the tour side, the days that you had to stay there for the tour, the hotel stays, the flight. But those extra days that you stayed just because you wanted to hang out, those are considered personal and won't be deductions to you. So remember, it doesn't have to be all or nothing for the trip. You just want to deduct the part that is related. Anita, did you see any specific questions that you thought that I should answer before I move forward?
Yes, I have a few that came through registration. A lot of them were very similar, but there are some folks that were looking to learn more about any common mistakes when filling out an LLC or S-Corp.
Oh, yeah. So usually, again, I'm not a lawyer. So remember that most of this is going to be legal related, but generally there's a couple of things. Make sure that you're using your right address. So if you are out of state or you are living somewhere, but you have a work address somewhere else, make sure that you're giving them the right information. The other thing is just to make sure that you're giving them details on when the business started and other information that you might have. So, sometimes they'll ask you when you first started taking income for this business, do you have anyone working for you? Being honest is going to be your best bet. And I will say, just in general, as far as taxes go, a lot of people will get scared about, like, well, what if I answer this wrong? Or what if I do this thing wrong? Remember that government agencies are looking for fraud. They are not looking for mistakes. If you make a mistake, they will send you a letter that's like, hey, you messed this up. This is how you do this thing differently. But usually it's just a recording of information when you're signing up for an LLC or S-Corp. And then mostly you just want to make sure that you're meeting the deadlines when it comes to an S-Corp election.
Another question we have is, I have an S-Corp. I do not have any positive cash flow yet. Does the 2024 Corporate Transparency Act apply to me?
No, okay. Corporate Transparency Act. This is another one of the, I hate keep telling y'all that these are legal and not accounting, but it is legal and not accounting. And they made some adjustments to the deadlines, but generally because you already had a business, you won't have to file that until January of 2025. The people that have to file this year and this month are ones that started in January of this year.
Another one around like, do you have any tips for separating business expenses from your personal account when you're starting a new business with low cash flow? So there's a lot of questions about if the people have already commingled their business stuff, business expenses with their personal accounts. How best can they kind of detangle?
Yeah. So first things first, you do what you do when you know how to do it. So don't feel too overwhelmed. I want to give you this information so that you know better going forward, but I don't want you to feel like, oh crap, I haven't been doing this right. And now what am I going to do? The first thing to do is to open a separate account. And what I like to tell people is if your business is not generating cash flow, give it allowance. Remember that that money is not income, right? You already had that. You got it taxed when you earned it from your W-2 job or however the money ended up coming into you. So what I generally say is give the business some money, transfer some money into the account. It pays its own expenses. You give it some more money. The other reason that that's going to be really helpful and important is because it gives you the ability to see whether or not it's sustaining itself and what it can actually cover for how long. So if you give the business $2,000 and that $2,000 only lasts 2 weeks, you know that you need to do something different on the business side in order to earn enough money. If that $2,000 lasts 6 months, you have a general sense of how much expenses are each month in order to keep that business going until it can run itself.
Going back to expenses and tracking, there was a few questions on, are they still tracking mileage and gas? And then also, how can you best find a list of resources of what is deductible, in terms of expenses?
Yep. I will make sure that you all get a copy of Common Deductible Expenses, but the Schedule C is going to take you a long way because it has the most common office expenses, travel, telephone, advertising, those kinds of things. Also, supplies, equipment, all of the things that you're generally running into. Remember that the idea is, again, that it's ordinary and necessary. So usually, if you need it to do the thing that you do, it's going to be deductible. You need instruments, you need audio equipment, you need venue space to rent in order to practice. You need all of those things that are like required for you to be able to do what you do. Those are generally going to be deductible. The things that get people in trouble are usually uniforms. So a uniform has to have a brand name or a business name on it in order to be able to deduct it. If you are wearing clothes for your tours or for your events that you could have worn elsewhere, the IRS generally says that's not a uniform. You could have worn that as regular clothes. One gray area is usually black tie or costumes, something that's like, yeah, technically I probably could wear it somewhere else, but I'm not. The only reason that I'm investing in this is because I have this specific event to go to. I'll generally allow that. And then your cell phone, just making sure that though you're probably not paying out of your business account, you're using it for business and you're deducting a portion of that.
Can you also speak on ways possibly to reduce your taxable income, such as investing in retirement accounts?
Yep. One thing that I didn't cover on, sorry, personal versus business. First thing that I recommend is that you go through and pull out all of your business expenses of your personal, put it into a spreadsheet so that it's really clear that it lines up with what you're reporting. And then again, even if it's not making money, open a separate account that you're transferring money into in order for it to pay its own stuff so that you're not out of order there. Here's what I will say about lowering your taxable income. Know that for the most part, your way to lower your taxable income is to spend money. That is not a bad thing, but we come to the end of the year and there is a lot of information that's like spend as much as possible because it will lower your taxes. I will give an average 25% tax rate. And what that means is that for every $100 that you make, you spend about $25 in taxes. I'm not going to tell you to spend $100 to save 25. So think about tax deductions as buying things on sale. Yes, it's cheaper than what it would have been, but the cash is still out of your account. One of the ways that you can do that benefits you, even though money is going out, is by retirement. And there are a few different types of retirement accounts that you can actually contribute to. One of the ones that I would highly recommend is a SEP IRA. And part of the reason is because you have up until the tax deadline or when you file to open it and to fund it. Whereas a 401k or something like that, you had to have done by 12/31 of the tax year. So definitely reach out to a financial advisor or one of the online service providers that will help you to create that. But remember that as you're putting that money in there, you're saving about 25 cents on the dollar in taxes. Everything else that you do is also saving about that same amount, but at least with retirement, it's money that you're going to get back later and your expenses you just spend. The other thing that I'll say about tax deductions is you don't want to spend your cash just to save taxes, because most people are in a your income is going to ebb and flow. And so I don't want you to spend all of your money at the end of the year and then touring is tight or you're not doing as much in Q1 and you don't have enough cash to hold you over because you spent all this money to save taxes.
Awesome. Let's do one more question. Apologies that we can't get to everybody, but I'm glad so many folks are really interested in, just getting their burning questions answered here today. There are some questions around, let's see. In terms of those, in terms of the LLCs and the S-Corps, in terms of payments, when going abroad or doing gigs in other states, can you talk a little bit about any pitfalls folks should know about in terms of, getting payments in other states, and of course, anything like royalties and payments abroad?
So remember I told y'all that all states were different because they are and treat them differently. So each state has a threshold, an economic nexus is what it's called, that basically says if you earn over this amount in our state, you need to report it. California and New York are like the worst at this, but generally once you exceed whatever their threshold is, and you should go on their state website if you are making an amount of money or a significant portion of your income is coming from a state that's outside of the state that you live, and they will require that you file a tax return in that state. You file it when you file your other returns, and what you're going to do is split it. So y'all know I like my $100,000. You make $100,000, but you live in Alabama, but like 80K of that came from work that you did in California. California is going to want to get taxes on that 80K. And what you'll want to tell Alabama is, I already paid California for 80K of this. I only owe you taxes on the 20K that wasn't already sent over there. So keep that in mind. It's going to be dependent on the state. Overseas is a little bit different. Well, it's a lot different. Essentially, the IRS wants to make sure that you're paying taxes to somebody. So if you are overseas, you either need to show, and there's a lot of like expat information and how many days you can spend overseas versus here to see how much you should have to pay. But just keep that in mind, that like as soon as those become a majority of your income, you want to start talking to a tax professional so that you know what you're headed into before you get to the end of that.
Awesome. Thank you so much, KEILA. As always, this was all incredibly helpful. There's so much information, and the takeaways today are really not only just helpful, but it really breaks down things in a bite-sized way, better for folks to understand. Of course, really for this presentation, just really leveling up on your taxes, kind of looking at that what's next. So thank you so much for your time, and thank you everybody for joining us today. KEILA, this was once again fantastic. All right, everyone, have a great day, and I hope everyone has a much easier tax season.
Thank you, everybody.